All right, what a close. What a way to close the week after a good breakout pattern on Wednesday, and pretty much a narrative changing breakout pattern, breakaway gap on Wednesday. So far, like, you could not have asked for a better 2 days to end the week after that kind of a gap to try to solidify that. So we're going to break down all the indicators that are pretty much showing us that we are full steam ahead to the end of the year, to new highs, right? That things are looking really good. Like, you can put me on TV along with Tom Lee and we'll be singing Kumbaya and talking about new highs at Christmas time. But there is one fly in the ointment. There is one pattern, very rare pattern that we're seeing right now in volatility, combined with some other patterns that you do see more commonly in volatility, that could really spoil the party. So I'm going to break down what that pattern is in today's video, why it's so significant, what it means, and what we can expect. Not only next week, because next week, again, it's the end of August, and last week before school starts for a lot of people. Our school starts here next week, next Wednesday. But it's kind of a traditionally slow time, but going into September and October, which traditionally is a pretty volatile time, we're going to break down what we can expect given these really bullish breakout indicators that we've been seeing. So let's go ahead and get started. Today is Friday, August the 12th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel, click that thumbs up icon down below the video, comment while you're down there, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Also, if you're watching us here on our blog, check out some of these things on the right. Come down here, click on this heart, it opens up a new tab. Hit that like button that pops up. Also click on this thumbs up icon, click on that tab. Click that like button there too. Again, the more you do that, it helps get our content out to all of our followers on these social media platforms. All right, well, let's start off taking a look at the market forecasts on the S&P 500, and look at this breakout. We have broken through now in 3 days. Boom, boom, boom. The 23% retracement level of this, the post-COVID rally that we had started to retrace on a long-term basis. That's a pretty long-term rally, and then now would be ending the retracement with the break above. So we've broken above the 23% line. We've broken above the 50% line of this market sentiment decline that we've had pretty much since the high of the year into the low of the year, and then now breaking above the 62% retracement level with a really strong, with even a bigger gain today than either of these days on a range basis. The biggest range that we've had, granted that was a pretty big range when you include the overnight session, but during the actual trading session, the biggest range that we've had, and really pushing us up to the highest level we've been above the 30-day moving average all year. In fact, you could say too, if you look at how far above the 50-day moving average we are. The 50-day moving average, we're 8% above. We haven't been this far above the 50-day moving average for, again, we have to go back to the COVID, and prior to the COVID level, which obviously is kind of more of an anomaly because, you had such a sharp drop in 4 weeks, right? So you're going to get big moves. Oh, we landed right on. That's pretty rare for me to do that. Again, we had this parabolic peak here where we got 9% above the 50-day moving average. It resulted in a cluster there and a gap, kind of an exhaustion type gap that we filled in there on the 3rd. That was a time, another time. But if you go back out, like, none of these other times have we been, coming off of. You can see coming off of here. So there's coming off the COVID low point. So coming off the 2018 low, we didn't get this. We weren't this bullish. Coming off of the 2015-16 lows, we weren't, that correction, we weren't this bullish. Coming off of the 2011 lows, we were, right? We did get 8.5% up above, and you can see at that time, that was kind of like the peak, right? That we were just starting. We did not get a cluster there either. We got 8.5%, 9% up above the 50-day moving average, and then we had an intermediate decline that resulted in an oversold cluster, a higher low point, and then a rally, right? That eventually we did get up to new highs there. So again, that's kind of like to show you what it looks like on this basis. So there's that peak up above right there. So the 2011, we really come off. We get dark green shading and green line. We're pretty overbought. Like very strong intermediate posture, very similar to what we have now. We got a cluster. We got a cluster later, right? It wasn't a higher high, but we got the oversold cluster later. But you can see that the volatility really kind of picked up there. Again, it was end of October 2011. We got the higher low point, and so eventually, so here's the peak that we had, the highs before this correction started. And if you follow all the way across, this was in July of 2011, you can see that we hit way over here in February of 2012. So that's what, 7 months, 6 plus, just under 7 months before we got back to the pre-correction highs. If not like all-time highs there, but at least the pre-correction highs. So, which is very typical for a correction, but you can kind of see how it started with, that strong move and then the pullback. Zoom out a little bit so we can see here's that coming off the bear market low point. We were 14% up above. Of course, we were coming from being 18% below, so that makes a difference. And before that, no other times. This time here, you can see in 2002, this was, again, coming off a bear market low point. We got to about 9%, 8.25%, 8.5% up above the 50, and then flattened out for a little bit of time. So needless to say, this is a really, really good move on equities to push through the resistance. Again, we don't just we also had a really good move to push through a resistance level here too, and we kind of ran out because we had the cluster and the intermediate posture got bullish. We weren't too high above the 50, but for that time, we were pretty bullish, and it ran out of bullishness because it took so much to get there. And if you look at our rate of change, here's another way of looking at this. If you look at the rate of change that we've had since that breakaway or runaway gap right there, the gap on would be the 15th. If you go all the way back over here, so there's been 21 days since that breakaway gap. 21. You can see now, I actually was looking at this earlier today, I have to move it up because we had a great close, 12.92. This is the 1 month, so 21 days essentially is a month, right? 63 days is a quarter, 21 days is a month. Again, we have to go back to COVID. Now, we were coming off a 30% drop there. We were only coming off a 10% drop now, but COVID got to that peak. You can see in 2019, we were coming off of a low that got to about 13% in a month. Again, we were coming off a low about 11%, so about similar to what we saw here. If I go back further, you go back further, you can, again, there's 2011. We have to go back to the bear market rallies, right? The actual bear market rallies, because the bear market didn't start until we failed in that correction bounce. The bear market rallies got this bullish, and of course, coming off of a 20% 1 month decline, and we rallied 22% to the upside, so that was bigger too. But you get this idea that this is a pretty rare bullish move that usually only happens when we're coming off correction lows. That would imply that this is a correction low point. Now again, 2011, remember we eventually kind of petered out and got a higher low point to form with an oversold cluster, but the correction low was in, right? And we were able to eventually work our way back up to new highs again within 7 months. Now the issue here is we're already 7 months. We're over 7 months away from the pre-correction highs. So we're not going to get to 4,800 in a month. So we're probably going to be at best 10 months, maybe 10 to 11 months at best before we get to all-time highs again. So that would mean about another 3 months. So by the end of the year, we would be working our way up again if this kind of week holds. Let's look at the market forecast on the weekly chart. And you can see here that, look at that strong, that near-term line getting well up above the 90th percentile. Now it got up there here too with the momentum line, no less. And your intermediate posture is just getting to, your intermediate line is just getting to the top end of bearish territory. You are above the 30-week moving average, but not by 2.5% yet. So you can see getting above 2.5% is a pretty significant change in direction. We've seen this before, right? So that solidifies the change in direction there, just like breaking below by 2.5% solidifies the change in direction in the downside. So as of right now, like this week is a this is a bearish pattern on the long-term chart, because you got the light green shading and the yellow line, and that that just like dark light pink shading and the yellow line is a like this one right here is a bullish pattern. You can see the bull signal there. That one is too. Now again, not all bullish patterns turn back up. You can see that trend change. We got one here and that trend change. We got one here. I mean, these are all corrections, right? We got one here, and that was a really good time to buy in 2018. If you go back out, how many times have we gotten a bear tag? This coming off the 2015-16 low was the last time we've gotten a bear tag, and it kept going on, right? The trend changed, right? So we got that there, and you can see here coming off the 2011 low, we got a bear tag. Coming off the 2010, we got a bear tag, and then coming off the bear market lows, we got a bear tag. But over here, you can see we got bear tags, and that was the correction bounce failure that led to the eventual bear market that we had after that. See, the bear tags. So you don't get a bear market without, usually without getting a bear tag. Even if you go back to let's go back all the way to 1970 on the weekly chart. Just to kind of show you, there's your bear tag here on in May of 2001. That was your correction. This was your failed correction bounce. There's your bear tag that led to a bear market, right? And then your bear tags that lead to the correction lows. There's a bear tag that led to the correction low point coming in. Here's all these bull tags. See how bullish these are when you get these pullbacks, right? You bounce back up. You can see the bear tags. Our last bear market our last significant bear market was here in the early 80s. You had your correction, you had your bear tag, and then your bear market, right? And then if you go back to the 70s, there's your bear tag in 73, 74, and then your bear market that came after that. So, this is either a pretty significant bear tag in that we are turning back up like most of these other bear tags, right? The probabilities are that if you were to count them all up, most of these other bear tags led to new highs within months, right? Correction bounces off correction lows. The only ones that didn't were the literal handful of bear markets that we've had since 1970, right? Where you just get these small handfuls. You can see even in 70, 78, there's your correction, there's your bear tag, there's your weak bear market. Correction, bear tag, bear market, right? So even in all of these, you get your bear tags, but you also get your bear tags at the end of the bear markets, right? At every single one of these, the end of the bear markets also. So correction lows, corrections end with bear tags, bear markets end with bear tags. This obviously would be a correction because you'd expect us to get to new highs here relatively soon. But bear markets start with bear tags. And again, the odds are this is a correction because the odds are we get a lot more corrections than we do bear markets. But again, we've seen this before that's led, especially whenever, again, we're breaking through some really important resistance levels in this one period. Remember, one period doesn't create a breakout, right? And now in the last couple of days, we've kind of held Wednesday's breakout above that black line. But this is on a weekly chart, it's one period. So we need to hold this weekly candle if we're going to have a long-term reversal of this trend back to the upside, right? So that we avoid what's the bear tags that lead to bear markets, right? That eventually lead to bear markets coming off of this correction low with that cluster there. So it's really, really bearish. But you notice again, we're not above that 2.5% mark, and that's kind of the key when you look at some of these other bear tags that we've gotten. It's been a while since we've gotten one. You can see over here we were just barely above it, right? We are just like barely 0.5%. But by the next week, not only did we hold it, but we were now moving up to more than 2.5%. So we really solidified the breakout, dark green shading and green line, right? If you go back to the bear market, the bear tag over here, we were not above 2.5%. We held until we finally got the dark green shading, the green line right there, and we were more than 2.5% above the 30-week moving average coming off of 2011. Coming over here, you notice we never did get more than 2.5% above the 30-week moving average, despite the bear tag. So you see, like, we can't just stop here, right? We need to push through, get above that 2.5% mark, hold this breakout that we got above some really, really important resistance levels and avoid the bear tag. Like I said, the bear tag turning into a bear market. So that's what we're seeing there on that particular chart. Again, like I said, that's a really good, like the near-term line's been at the 90th percentile now for 3 weeks. That's really strong. Now the momentum line's not really staying up there, but still, that's really, really strong, and it might be just what we need to get that intermediate line eventually to turn. Remember, we don't get the dark green shading until the intermediate line's above 50. We don't get the green line until we're above a rising 30-week moving average. Obviously, it's going to take being more than 2.5% above to get that rising to the upside, to get the dark green shading. But looking really, really good, not only on this chart, but also on this weekly chart. Right, we are now on a Hakinyashi closing basis. There's a Hakinyashi candle. We are closing above the 40-week exponential moving average. So we've already been above the 10. You can see the positive candle differential really, really high, so very strong levels. The PPO has really shrunk. There's only a 3% gap there. We haven't got the signal, the rollover yet to the upside. Again, going back to 1970, when you look at like these corrections, you go right back up, right? You come up, you cross zero. You come up, you cross zero. 15 and 16 was our closest to turning into a bear market, right? This failure right there. But we turned around and we got back above zero there in 16, the PPO. 2011, we got back above zero and stayed above zero. 2010, we got back above zero and stayed above zero. 2012, we got to 1.5% in between, and we couldn't get above it, right? We closed a smidgen above it right there, but we couldn't stay, right? We couldn't keep going and stay up above it. So we've seen this, we've seen what we're seeing now, we've seen before too. So we need this to keep going, and it's at a rapid pace. It's not going to take, if we get another good strong week or two going into September, then that's going to be close to zero, or right at zero, probably within a couple of weeks. So it's going at a good pace. What's also really, really good for us right now is the RSI got above 70. Remember how I talked about how they break out of a range, you have to break up above 70, right? To break out of a, when you're bearish, like so here you're bullish, you kind of had one above 70 at the end. This bearish period didn't start here, it started, sorry, let me activate this. It really started over in this area, right about there. So which means this bullish one started, whoops, this bullish one ended over here. All right, so really to break you out of a trend, from a bullish trend to a bearish trend, you got to get below 30. To break out of a bearish trend, you have to get up above 70, and that looks like what we're doing right now, right? It looks like we are breaking out of this. Not only have we gotten above 60, but see, we got above 60 over here, and that didn't change it. So not only have we gotten above 60, but we're above 70 now, with a really strong above 150 on the CCI. On the weekly chart, we're very, very strong levels here too, almost up above 60, which you'd like to see on the weekly as well. But we're looking really good. I mean, look at that 4 week rally we've had, and really it goes 1, 2, 3, 4, 5, 6, 7, 8 weeks of moves to the upside off of that June low point. Really, really good move. Looking at the DMI, we have dark green shading. Like the ADX is above 25. You have a strong trend. You also see that too with the Ichimoku chart here. We are above 5 or above 80. We have a strong trend. We are easily above the cloud. Like by the time we get to the green, there's a very, very likely good chance that we're gonna be above the cloud. See, we weren't over here. By the time we got above the green, we got to the green, which is this rally, we weren't able to stay, right? So when you get the pink, by the time you turn green, you want to be above it. And that sustains it, right? So you can see it all across the board here. When you get the pink, by the time you turn green, you want to be above it. When you get the pink, by the time you turn green, you want to be above it. Pink, by the time you turn green, you want to be above it. So the pink represents the declines, 26 days forward, and the green represents the rallies, 26 days forward. So we need to maintain the rally, we need to stay above it, by the cloud, by the time we get to the green. See, like I said, there's the rally here. This green is that rally there. By the time we got to the green, we were not above it, so we weren't able to sustain it. That's 26 days out, and that shows you again. And that was it wasn't a mature bullish trend, but it was an intermediate trend strength, and then it was done, right? So this is a really, really good sign. From a Bollinger Band perspective, you can see the Keltner channels are looking really good too. So here's your TTM squeeze. There's your strong momentum. It's really, really high. We're between the cloud and the Keltner channel and the bandwidth, excuse me, the Bollinger bandwidth. We are up in the upper quartile of bandwidth. It's a pretty high bandwidth, but that's a good sign too. I mean, this is a good bullish trending pattern. We only had it for a day there, so a lot more than a day here. So that's looking really good from a trending standpoint. Let's see here. What else I want to show you? I wanted to show you the hull pattern. We've already talked about the 200-day hull. You know, we're the highest that we've been above the 200-day hull since these trends changed, right? You have over here, this 11.8%. We were at 18% above the 200-day hull there, coming off of the COVID low point. Over here, we got about 8% above, so not nearly as strong, but obviously not nearly as low either. We're only 15% below it. Whereas over here we were only about 10% below the 200-day hull. So this is a pretty good move up above. I mean, it's in the 82nd percentile, and really the only levels that are getting up above it, 11.87. And the hull is a very fast-moving average, so it's even faster than your typical exponential moving average. You can see, coming off of major lows is the only time we ever get that. We were in this area pretty far above it too. We were about 8% up above it there. So keep that in mind in terms of that May 2008 time frame. But you can also see too, we've had 3 days now. This is Hakunashi candles. We've had 3 days in a row that CPI day was a good bullish breakout candle, closing above all these highs. The Hakunashi close, no less. Yesterday we closed above the prior day's high. Today we're not closing above the prior day high, but it is a higher close. It is still above the 20-day hull in green, but you see that parabolic SAR is very close, which means we're pretty susceptible to flipping, right? Flipping that parabolic SAR when it's this close. That just essentially means that we're very mature in the move that we had. Like it's, you've got it's hard to sustain when you got a 20-day move. So essentially, remember it's 21 days since July 15th is the 21st day there. So this is a 20-day haul, and we've been above, it's been green for 20 days. That's about the time frame, right? So the parabolic SAR suggests that we're going to, at least get where is it? This kind of pause or this kind of pause. But in the opposite direction, right? And or we can be able to keep going to the upside at the very least. But again, you can kind of see that, we're kind of right there right now on a very important indicator, right at a peak, right? A pretty significant peak. Whether or not we can maintain, whether we can turn that peak from Mount Nebo, which is right outside my window, which is maybe over 13,000 feet high. If we can turn that into Mount Nebo or Mount Everest, turn it into a much bigger peak remains to be seen. But as of right now, that's what this is saying is this is a pretty decent peak. Maybe not even one of the 14ers that you see all over Colorado. It's like Southwest Colorado there. Let's see here. Let's look at the VIX. Now here's I spent a whole class today on technical analysis with our market scholars on volatility, and just to kind of give you a little preview of that, we have had a little kind of what we talked about. We've been on an 8-week streak to the downside in volatility. Volatility has been very bearish, right? The last time we've had this long of a streak was coming off that 2018 low. We had a 9-week streak, and the streak went from about where we started now, just a little bit above 30. Right, that's where we started, and we ended below 15. Right, and we started from above 115%, which obviously we were only at here we only started at 96%, so not nearly as high. Even though on an absolute basis it was the same level, on a relative basis it was actually much lower compared to VIX 3M than it was back in 2019. We got a big streak. This streak, instead of getting us below 15 before stopping, it got down below 20. But here's the other big difference that we see on this volatility drop that we haven't seen on the others, coming off of major correction lows. We have not seen this pattern. So I'll repeat, we have not seen this pattern on any of the other moves off of correction low points, right, that have led to new highs. And that is, let's see here, let me get on the weekly, it'd be on the daily. That is this far of a, what are we now? 44% negative correlation. So this is, let me put this at negative 44. 44% negative correlation. Let me zoom out a little bit. Like, it is not typically this bearish. And you notice that when it is this low point, as you can see these last two, when it is this low, it's because the VVIX has been rising, right? Just like it is right now. The VVIX is rising. The VVIX was rising there. The VVIX was rising there. Now you'll notice what that has led to in these other instances. It has led to a sharp return back to what is normally a very high correlation. Like here is the 75% mark. Here is the 75% mark of that correlation level. 75%. Let's do here, and let's do one. So that's the 75. You can see it spends most of the time above 75%. Anytime it dips below 75%, it goes right back up. It does not spend very long below 75%. Maybe a few days. But generally, it's more than 75% positively correlated, which means the VIX and VVIX go up together most of the time. It has not been the last 2 weeks. VVIX has been rising, and as we saw, the VIX has been dropping over the last 2 weeks. This is a 10-day correlation. In the past, when we are this negative, the VVIX responds very quickly back to a very positive correlation. So that means that what they have been going in opposite directions in the last 10 days, they go back to going in the same direction really quickly. Now you'll notice that after all of these bottoms, look what happens to the VVIX. It spikes, and this one has spiked up to 150. This one eventually spiked up to 145. The VVIX spikes from what was low levels then to really high levels. And you can see over here, this one we actually dropped, but then it spiked eventually up with the COVID drop. So it was really setting up this divergent highs at the end of that 2019, early 2020 going into COVID. So here we are now with the same thing. VVIX is rising before the VIX is rising. In the past, that means that this correlation typically goes right back up because we've been below 75 for more than just a couple of days, right? Like this correlation went negative on August the 1st, went below 75, excuse me, on August the 1st, and it's been negative. It's been moving down to these negative levels very quickly. You would expect it's going to bounce back up really quickly. And so when it bounces back up and the VVIX spikes, as it has in the past, then we can expect the VIX to spike up with it because the correlation goes back up to positive 75, which means that we might be in this situation, and you can see here too on the volatility level, that the VIX, even from a range standpoint, the VIX, usually when the VIX is really low like this, on an average basis here, when you normalize it to the price, when it gets really low, it gets low because the VIX spikes faster than the range does. And so you end up with a really low level on the ATR relative to the price because the price moves faster than the ATR does, and eventually, but that's not the case. This time we have a really low ATR, not because the VIX is spiking, but because the VIX is really low. The VIX is on an absolute basis is really low. On a relative basis, it's as low as it is during VIX spikes, but we're not spiking. So the range, in other words, the compression, the move on the VIX is getting, the ranges are getting smaller and smaller and smaller and smaller, and that typically leads to a spike in volatility. The other thing too that I mentioned in my class, when you look at the VIX and how it's performed over the last couple of options expiration cycles. Let's go to VIX here. you can see that we have dropped below, like the VIX has had 2 expiration cycles now. Now August is not done, we got 1 more week, but next week more than likely is going to be a really quiet week. It's the last week before school starts for a lot of people. So the market ends up being really quiet, very low volume, very low volatility, very, not really a whole lot going on. Unless we get something market moving in terms of a headline, I wouldn't expect a very big move in the market next week, right? And so we'll probably end the options expiration, as we typically do, with low levels. But you notice down here, these are the gaps. So this is when options, this is what the VIX does when it starts the first period after expiration. So that first Monday after expiration, you can see it almost always gaps up. And there's a lot of gaps here of, one standard deviation is 5%, another standard deviation is 11%. So you typically get a big spike up, regardless, on average. I mean, of course, there's some red bars in here, but for the most part, you get big spikes up to the upside. And you also notice that every time you get a 20% drop over an expiration cycle, it typically leads to some bullish moves over 1 or 2 expiration cycles after. Especially in this case, to get 2 in a row is pretty rare. We've seen a couple, only a handful of these. We've gotten 2 options expiration cycles in a row with 20% or more declines in the VIX. So you see how we are setting up with that extremely rare negative correlation with the VVIX, with the ATR on an absolute basis and a relative basis as low as it is, and with 2 consecutive cycles of extremely low levels. It's pretty rare to get that combination. That typically in the past has led to jumps in volatility, not accounting for the fact that we are in a seasonally bearish time of year, a bullish time of year for volatility, right? We've shown you, I think I've shown you that before, but when you look at it on a weekly basis here, you can see like we've already started, but even from here going forward, this is a pretty bearish time of year or at least, bullish time of year for volatility. So like, again, we have some really good patterns here that suggest that this breakout is going to lead us to new highs. But volatility, as well as some other things, suggest that if we don't, like if this doesn't, and we fill in that gap, we fill in this gap next week or the week after. Probably it would be the week after, because next week I would assume we're going to probably stay within like today's range next week, unless, again, we get a market-moving headline. Again, it's the last week of school. August is really, really quiet. So if in the next week or 2 we can't hold that weekly, then we get that bear tag in the weekly chart, right? If we can't hold this weekly breakout in the next week or 2, and we get back and fill in that gap and go beyond, because this is all going to come off the table. This is going to be our big support level, and go beyond. Then again, like we saw in March 29th, so I compared on Wednesday, I compared that move to March 29th, then you can expect that we'll get, that kind of move again and again. Considering the bear tag on the weekly chart, that's not necessarily something that we all want. I think we all want this to hold and eventually get up to new highs by the end of the year and do what every other correction has done, and including this one, right? Get up to new highs and then push through and get this market sentiment into bullish territory and then stay there for a while. You can see this market sentiment line can stay in the orange line. I can't really see it as well, but if I were to bring up market sentiment instead, if I bring that one up instead, you can see when it gets above 60, there's 60 right there, it can stay above 60 for a very long time. In fact, it doesn't stay below 40 for very long when we get our corrections. But when it gets above 60, it can stay above 60 for a very long time. In a worst case scenario, have brief little intermediate pullbacks into the neutral zone, and that's it, right? It can turn right back up and stay above 60. So this kind of intermediate run is something that you would expect to see, if this can hold, right? To get above 60, and you can see when it gets above 60, like I said, coming off the lows is great, but even just crossing 60 starts a year-long or more bullish move that we would all love to see, right? Let's see here. I think that's the last chart I had on my chart here. And I'm going to look at how some of the other asset classes are doing. But before we do that, just kind of like a halftime What do you think? What do you think about the charts I just shared with you? What camp are you in? Are you in the camp of this is a great breakout that, like I didn't show you this one, where we got that thrust from below 10 to above 90, that we've got the breakout move. We got the charts that are telling us we are going up to all-time highs. Are you in that camp, or are you in the camp of, if that volatility storm produces this volatility tornado, then we're going, then we're really overbought right now, going into, like I said, a potential volatility tornado. Like I said, that we have not gotten before on any of these other moves off of correction lows. This is the first time that we've had to move off a correction low that we've had that big of a negative correlation on the VVIX to the VIX. So, which side are you on? Share with that down in the comment section below. And if there's any other charts that would lean you in either direction that you want to share, post those in the comment section below as well. All right, now let's break down what's driving, and I took a long time on that segment, so I'm going to not nearly be as long this go around. So let's go to let's see here, the bonds, and how long-term bonds are doing. Remember, bonds broke down below the 30, below the 50 at the same time, as well as this kind of volume node here. So remember, bonds falling. Bonds and stocks in an inflationary environment typically move in the same direction. In a disinflationary or deflationary environment, according to John Murphy, stocks and bonds move in opposite directions. So that's the environment we've been in for a couple of decades. Basically since the early 80s, we've been in this disinflationary environment where yields and rates have been in this long-term declines. Right? So stocks and bonds move in opposite directions in that environment. When they go together, like in the 70s, when you're in this inflationary environment, they go together. So stocks and bonds move together, and so bonds dropped yesterday and really broke down below that 50-day moving average again for this inflation, which we are still in an inflationary environment that has been bearish for equities in the past. Now it rallied a little today, up 1%, but not back above the 30-day moving average, and not really even above the halfway point of yesterday's range. So keep that in mind about bonds. Commodities had a really good move yesterday too, gapped up. Again, that's been a bullish, bearish thing. Again, that kind of goes with this inflationary story: rising yields, rising commodities. You broke up above the 30-day, on Wednesday, and then you really solidified it yesterday. There's still a gap up here, but you've essentially come off that 200-day moving average. You've got a rising MACD. You're above the 17-day moving average. You're pretty bullish there. The dollar broke down to this 23% long-term retracement level. It broke below the 23% of this current move's retracement. It got a little bit below the 50. It rallied back up and got a little bit of an engulfing pattern yesterday and continued higher today and got back above the 50. Now we're not back above the 18. The MACD is not back above its moving average, nor is it back above 0 yet. So we haven't, like, one day doesn't mean that we've held support now. We're not back above that 23% line. But again, a rising dollar with rising commodities and rising yields has been the story of the year, and that's been bearish, and that's been the pattern we've gotten the last couple of days, and that has not translated to weaker stocks. So does that mean that this story has changed, that we are no longer in an inflationary environment? We're back to a falling yields, falling disinflationary environment, or is this just a kind of an anomaly, right? Because correlations aren't always 100%, as you saw with the VVIX and the VIX. Correlations aren't always 100%. Let's see here. Let me go to, and then let's look at this past week. Let's go to the last 3 days. Well, let's go to the last 2 days, especially. That's because that's where the divergence have really taken off here. Let's go to the 5-minute chart. So here's equities, but there's bonds, right? So commodities are up, bonds are down, the dollar is up. That has been a recipe for most of this year to date for bearishness in equities, but IWM's up 2.5%. Right now, again, IWM. So this isn't the Qs. The Qs are actually lagging the S&P 500. When you look at it from a sector comparison standpoint, you look at August the 11th and 12th, again, this last 2 days post this Wednesday move, right? You can see that XL Energy is up 4.25%. Financials up 2.75%. Materials, industrials. These are your big winners right now. These are kind of the reopening trade. They're associated with small cap stocks. Even though these are all S&P 500 stocks, these sectors are associated with small cap stocks. They're very small sector weightings in the S&P 500 right now. Whereas technology and utilities moved hand in hand. Now that's not typical for a risk-on environment to have technologies and utilities move hand in hand. But so again, that kind of shows just like how bullish are we? Well, that's how bullish we are. Technology and discretionary are not the drivers. They're actually right there with the safe havens and lagging the market, lagging the rest of these moves. So that kind of makes you wonder a little bit about what's really driving this action. That will show up here when you're looking at this chart. So this is the chart of the yield spread between the 7-year, or this would be the 3 to 7 year treasuries and high yield bonds. Really, really low levels. Again, we saw this back in June, late May, June. We saw this back in the end of March. So very low levels again. In other words, risk appetite is extremely high right now. So it's either really, really high and able to get us going to the upside to the end of the year, or really, really high like it was at the end of March and then end of May, beginning of June, and it's set up for some bearishness in equities. But let's look at the Qs versus IWM, right? Because this relationship, if we're going to be bullish, this relationship should be going up, and you notice that hasn't been the case. In fact, in the past 2 days, if I were to go back to just a 1 year chart, in the past 2 days, we got red candle. In fact, we've gotten 3 days in a row of declines. We're back. We are below the 50-day moving average. The 8-day is below the 17. They're both crossing below the 30. They're moving towards the 50. The MACD is dropping. The CCI is dropping. The RSI is dropping. Like this is not the type of move that you would that would push us up to new highs by the end of the year. You want the Qs to lead up, not IWM to lead up. That's not, with the sector weighting disparities in the market, with XLK and XLY being by far the biggest sector weightings in a market cap weighted index, you want your bigger market caps leading the way. When you have the smaller segments of that market cap weighted index, when you have the smaller market caps leading the way, that's not necessarily the best sign. You can see here in the S&P 500, your biggest winners. I mean, you have some semiconductor stocks that had a really, really good day today. Micron, Nvidia, they have been so bearish. Tesla is a big market cap stock. It did well. Nvidia, of course. Pfizer is another big market cap that did well. Disney had a good response to its earnings. There's Charles Schwab. But then that's really it. Like, none of these the top performers were, big market cap weighted sectors outside of semiconductors. They were sectors in financials and materials and industrials and healthcare. There's Cardinal Health. Consumer discretionary in terms of like these reopening trades. And again, like, they didn't lead us at the new highs last time. That's the issue. And so, you wouldn't expect them to lead us up to new highs this time either. We got to get a shift in leadership next week. We have to get XLK. You have to get the bigger market caps leading the way higher. I mean, they had good returns, but these weren't leading the day, right? So only really this Tesla and, like I said, Nvidia, and all the rest of them. There's a few others. Pfizer, Eli Lilly had a good return today. Merck, healthcare stocks, right? There's Disney, there's Oracle and Adobe, but everything else is kind of small gains that are very, lagging. They're lagging behind the broader markets return, especially kind of the overall VTI, which ended up being up 1.75%. All right, so for our trade idea of the day, I wanted to take a look at UNP. It's very similar to the S&P 500. Like, if you look at its rate of change over the last 21 days, so the same, it gapped up, the same thing on that day before July expiration. Let's go to UNP here. It's up 16%. And again, we've had similar types of move before, but this is a really, really good return, as you can see back in the past. It's a great move up to the upside. When you look at like the market forecast for UNP, you can see that the intermediate posture, strongly bullish. We are 7%. We're the highest above the 30-day moving average we've been in the last 52 weeks, barring that one. Excuse me, there's that move there that we didn't quite get up there. Let's take a look at this really quick. October 26th of 2001. Let me come over here, and you can see how we're approaching, and not just in the broad market, but especially in UMP, the point of control and this volume area. So over here on October the 26th of 2021, so let's go October 26th, 2021, and we'll go to October 27th of 2020. You can see there we were not butting our head up against resistance. We had broken through the resistance of the 1-year point of control and the value area, and we were bullish. Now we weren't, as you saw, we weren't able to sustain it, right? We were kind of just stay sideways, but we were above that point of control for a very long time. That now is the point of control, and unlike that time where all that bullish move got you through a very strong resistance, this tremendous bullish move has got us to a really, really strong resistance. Even stronger than that last one, because that last one was a much skinnier node. It was as wide, but it was still a much skinnier node. This is a pretty thick node here in this area. There's a lot of volume in this spot, and you can see again the bandwidth was even more. That was the stronger bullish move that got us there than what we even have here. So it's a strong rally, very strong trend, right? UNP is showing a mature bullish trend. You can see we're not to the green yet. We're still up above the yellow. The DMI shows the same kind of pattern we see on the S&P, kind of a parabolic move on this chart, even more parabolic on the 7-day chart. But that's a pretty, the negative indicator hasn't been this low since that move, right? Over here kind of got that low as well, and at the end of March. It was a pretty tremendous rally for UNP to get us to a resistance level. Let's see, I showed you RSI as well. You can see a very strong RSI. Again, we haven't seen that since over here. And remember, the difference between this spike, this move higher, was it got us through resistance, volume resistance, point of control, volume resistance node. This one has gotten us to a much thicker volume node, point of control, with a pretty dramatic move. So what I decided to do here is, we've made some bullish trades, right, over the last few market outlook videos, as well as in our directional option strategies class this week. We made plenty of bullish trades. So what I wanted to do with this trade is to kind of complement those bullish trades with a bearish one. So I'm going to come over here to the September expiration, and I'm going to buy this out of the money put 230 and sell the 225. So that gets us down by September expiration towards this 223 1 standard deviation mode. This is what it looks like here. So this is the trade. There's our maximum gain inside of 1 standard deviation. So with a very small risk, if it breaks up and it keeps going through, we get a couple $100 of loss. But if it doesn't, we get a $2,000 reward. If we do, if this other scenario that I've talked about today, this kind of volatility storm produces this tornado, this spike in volatility, then we've got a good return to the downside. Again, like I said, to complement the other bullish trades we have right now that we can use to take advantage of the market continuing to rally, and this will kind of soften the blow a little bit if the market ends up not rallying with a really good move to the downside, trying to take advantage of a stock that I feel like is one of the better ones to take advantage of if we aren't able to sustain this week's breakout. Alright, well that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Follow us on Twitter. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. And we'll see you all on Monday next week. Goodbye, everyone.